All right. Looks like it's a couple minutes past the hour. We've got a few more logged on, so we will go ahead and get things started. So thank you very much for attending our webinar this afternoon. I know this is lunchtime for a lot of people, right smack dab in the middle of your day. We're going to try to be respectful of your time. We'll go ahead and get right to the presentation. My name is Dane Williams, and I'm an advisor here at Howe Financial Services. And we have put a focus on long-term care and long-term care planning in the month of November. Many of you know, you may have seen our social media post. November is Long-Term Care Awareness Month. And so we're really happy. We've had this set up for a really long time. So we've been anticipating this webinar here. We have Clint Thomas with us today. Clint Thomas is with Pacific Life. He is a long-term care regional director with Pacific Life. And he's mainly in the Great Plains area, but we're lucky enough to have him cover our region as well. He has more than 18 years of experience in his current role at Pacific Life. He is a certified retirement counselor. And Clint, if you're on the line, it also says you like to play bass guitar and you jam with your former bandmates. Is that true?
Absolutely.
Awesome.
Absolutely.
Awesome. Good deal. Well, I will go ahead and let you get things going here, Clint. And there's, just so everybody knows, there's not going to be any Q&A on this call. Everybody's in view only and listen only mode. But if you do have any questions, we just encourage you to give our office a call, send us an email, whatever questions you may have, go ahead and send those along. But I will go ahead and turn things over to Clint with the presentation. Hope you enjoy.
Great. Thank you, Dane. And thanks everyone for jumping on over your lunch hour. Again, we'll keep this to about 20 to 30 minutes tops today. And really, what we want to accomplish is just enlightening you and educating you on the evolutions of the planning tools that are available today. Some of the modern planning solutions that are available today in the long-term care space. Again, my name is Clint Thomas. I'm the Long-Term Care Regional Director with Pacific Life. Born and raised in Omaha, Nebraska. My territory that I cover is Nebraska, Iowa, Kansas, Missouri, and Southern Illinois. I have two children. I have a 19-year-old son and a 16-year-old daughter, sophomore in college, sophomore in high school, and just really excited to be a part of this today. So we're going to jump into it. And today's presentation is what you may not know about long-term care. So when we talk about long-term care, it's different than healthcare. The healthcare industry, and I apologize, I have a dog here. We're all working from home, right? So it's different than your health insurance or your Medicare that you may have. Long-term care really is about when you get sick, hurt, and you need help. Those are the types of policies that we look at. When you look at long-term care, it's more of not being able to do what they call 2 of 6 activities of daily living, which is eating, bathing, dressing, toileting, continence, and transferring for at least 90 days, or that cognitive impairment. So like dementia, Alzheimer's, or maybe a fall or a car accident. Those are things that are when you need that extra level of care, is where your typical health insurance that covers your doctors, your surgeries, and prescriptions are not covering on that end. What are some of the types of the long-term care where a policy may pay for? So in-home healthcare has become a very, very big and popular part of long-term care planning. Home Instead, which is based out of Omaha, Nebraska, started about 20 years ago, multi-billion-dollar franchise. So I think Americans are staying at home versus going to, say, an assisted living or a nursing home. Adult daycare is part of that. Community care centers where you can buy into these gated communities, and those are becoming a little bit more popular as well. When we look at long-term care instances, a lot of it's driven by age. The average claim in the long-term care industry, about 66% of claims start at age 80 and older in the United States. A lot of it is dealt with health and family history. Gender has a big deal with it. And I think one of the number one reasons of individuals that go to a full-blown 24-hour memory care unit is Alzheimer's and dementia. I'm very familiar with it. My grandmother went in here in Omaha, $8,500 a month in her late 70s, died at 98. So she was in a memory care unit in Omaha for about 14 and a half years. Things that, really when we talk about planning for the unexpected, those are some of the things that we want to consider when we're talking about this risk. So long-term care considerations, really there's a few things. I think we can all understand, that the government is there to help, but there's a couple government programs, and I'll go into those, called Medicare and Medicaid, health insurance and disability insurance. So the government programs with Medicare, typically when you're in that home, the hospital for 3 consecutive nights and you have some skilled rehab, there is a benefit with Medicare that will pick that up, whether you're 65 or not. That Medicare typically picks up the first 100 days in that skilled rehab program. Typically day 1 through 20 is 100% coverage. Day 21 through 100 is like an 80-20 coverage. Medicare will continue to pay for skilled rehab. I look back at like my father at age 43. I was a young caregiver at age 20. So that's why these planning topics are top of mind and close and near and dear to my heart. He went into a skilled rehab and actually plateaued out at about 3.5 weeks in. And so once you're not able to improve in those situations, that's where Medicare will stop paying premiums. Medicaid is more of impoverishing yourself. So that's where, when I look at my grandmother's situation, the last 2.5 years of her memory care unit stay, we had liquidated her down to 4,000 total in Nebraska. Total assets was 4,000. So we had to sell her home and all of her investments and get down to that. And then Medicaid picked that up, and her Social Security, she was able to keep about $50 a month. But Medicaid typically isn't the best plan. Maybe it's that spend down where you're impoverishing yourself. If you are married, the nice thing is it's about $162,000, one house, one car that the spouse gets to keep. And sometimes the states are nice enough to allow you to keep the greater of the 2 Social Security. So a couple government programs that help out, but not necessarily probably the best plan to have. Health insurance, again, they pay for your hospital stays, your doctors, your prescriptions, but once it shifts over to home health care, nursing home, assisted living, health insurance doesn't pay for that. Disability, you may have remembered the duck with Aflac. That's more, you got hurt, you're not able to work, and there's a triggering point where they can help pay for some of the bills that you may have and are accruing while you're not able to work. But again, when it shifts over to that home health care, assisted living, nursing home scenario, disability insurance does not cover. So options for paying is really, you look at looking at a long-term care insurance policy, or what we call self-insuring, where you're utilizing your own assets. Again, that's where you get to talk to Dane and the advisors with Dane and talk about what your plan is. Is it self-insuring, or should we look into a plan or a policy? And we talk about affluent clients as well. So what if you're a type on this call that could buy the nursing home, meaning you're wealthy, you've created a lot of great wealth, and why would you consider long-term care protection? So when you're thinking about self-insuring considerations, there's a lot of things to think about. What would you liquidate first? What are the costs of liquidating those assets? How will that impact your retirement income plan? And your beneficiaries, if legacy is a concern and you'd like to leave some dollars that you've accrued over your lifetime to your kids and grandkids. When we think about self-insuring, a lot of that is, even if you're able to pay for that, thinking about, why should we pay for this when we could leverage up an insurance company's money, use that money guaranteed and tax-free in the event that you have that long-term care event. And we'll get into some of the planning pieces and types of solutions that are out there today. But self-insuring is, and we find there's quite a few Americans actually today that are doing that self-insuring, but some of that is because they're not aware of some of the modern planning pieces that are available today. So what is long-term care insurance? It's been around a long time. Started in the late 70s, so north of 40 years. And a lot of those older policies were nursing home only. Since then, they've made a lot of improvements with these newer policies that include home health care, assisted living, adult daycare, home modifications. So they've really expanded a lot of the coverages versus just a nursing home only insurance. Some of the common long-term care insurance types today, I like to look at this as the old, the new, and the modern. So you look at the older plans, 40 plus years that they've been around, traditional long-term care insurance. The new is life insurance with an accelerated death benefit rider, where you buy life insurance and can access the death benefit tax-free for a long-term care event. And then the modern is more of the asset-based long-term care insurance, which that's what I actually represent with Pacific Life. So let's jump into the different types. Traditional long-term care, been around a long time. And some of the advantages with traditional long-term care is it tends to be on the lower end of cost, meaning your premiums tend to be lower than some of the modern solutions that are out there. It allows you to increase funds, so you could turn $1 into $3 to $4, 100% tax-free. Kind of keeps your retirement assets from being liquidated to pay for long-term care, which is, I think, a big deal when we look at this. And traditional long-term care has that inflation option of 3 to 5% that'll grow that pool and those dollars available for long-term care on a guaranteed basis. Some of the disadvantages is the payments that you make on these are for life. So if you buy something in your late 50s, early 60s, you're paying those premiums for 30 to 40 years, no different than you pay for homeowners insurance and car insurance. Premiums may increase over time. That's one of the disadvantages with traditional. Still a good planning piece, but we are seeing some carriers like MetLife, John Hancock, Genworth that are increasing premiums, meaning you're not getting any more coverage. It's costing a little bit more. And then I think the bigger of the disadvantages for traditional long-term care is if long-term care is never needed, the insurance company keeps all your premiums and you don't get any money back unless you actually have that long-term care event. So it's kind of a use it or lose it type of solution, but tends to be some of the lower premiums and a little bit more budgetable over time. The modern, if you will, or the new is life insurance with an accelerated death benefit. So some of the advantages there is that it accelerates the death benefit long-term care. So you may buy a $250,000 death benefit. If you passed away early, that $250,000 comes back to your family tax-free as a life insurance proceed. However, if you need long-term care, you can access that $250,000 death benefit tax-free to pay for home health care, nursing home, and assisted living. Some of the disadvantages is the long-term care benefits, if triggered, will reduce that death benefit. You have to qualify for both the life insurance coverage and the long-term care coverage. So it's a fully underwritten process, meaning they're looking into your family history and medical records and taking fluids and things of that sort. And inflation benefits are not included, meaning so you buy that death benefit of $250,000, that's what it's worth today at 60, and that's what it's worth at age 85 as well. But still a good plan for it not being a use it or lose it like traditional long-term care. And these tend to pay in over their lifetime as well. The modern, the asset-based or hybrid, you may be reading if you've done some research. A lot of the advantages is that everything is guaranteed, meaning your premiums will never increase. A lot of these you can do a one pay, so typically repositioning lower yielding assets in your portfolio like cash and CD, money market type scenarios, so we could leverage those up. If long-term care benefits aren't needed, your beneficiaries will get that back, your premiums back as a life insurance death benefit, tax-free. And another nice thing, especially with like Pacific Life's product, is your cash surrender value remains an asset on the balance sheet, meaning you're repositioning a CD of, say, called 50 or 100,000, you get that coverage. But if you ever want that money back or want to do something different with these new asset base, you can just take that money back, no surrender, no taxes. So it's like cash on the balance sheet. Some of the disadvantages, premiums tend to be generally higher than traditional long-term care with these asset-based plans. And your death benefits normally just return a premium. So if you've put 50, 60, 70, 80, 100,000 into these policies, that's typically what you're getting is just back as your premium. But again, this is a great option for those, especially the affluent that tends to feel they could self-insure. And here's a way you could reposition some of those low yielding assets, probably typically the assets you would want to liquidate first in that event, and maybe leverage those dollars up on a guaranteed basis and use those dollars tax free. So again, this is just kind of a summary of what I just discussed. Traditional long-term care, really, if long-term care is your primary concern, death benefits a secondary concern, you may be looking at traditional long-term care insurance or the asset-based life long-term care insurance. If life insurance is for your primary concern, long-term care tends to be a secondary concern, then you may want to consider that life insurance with an accelerated death benefit rider, that you're buying more life insurance but can access that if you have a long-term care event. So designing your plan, these are a lot of great questions to maybe notate if you have a pen and paper to ask Dane and the planning group there. So how much long-term care benefits may you need? A lot of times where we see these is most consumers aren't looking to cover every dollar with a plan, but they know that they don't want to take on this risk because it's a significant risk to the financial plan and the portfolio. So they're finding somewhere in between where if they could cover maybe half of what a private room may be in your area, you still have Social Security assets off the portfolio, maybe an annuity income if you're fortunate enough to have a pension. So those are things that you could talk with Dane and the group about. Looking at how long should long-term care benefits last. I will let you know that Genworth, who has been around for north of 40 years and really started the traditional long-term care route back in the late 70s, they're experiencing an average claim on their full block of business of about 5.5 years. So when you look at that, it's started at home, evolved to assisted living, and then your last 1 to 3 years may be in that full-blown nursing home scenario, unless you're like my grandmother who was there for 14 years, but that's kind of an outlier of circumstances with Alzheimer's. When do you expect you might need it? Typically, again, 66% of claims start at age 80 and older in the long-term care industry. Doesn't mean that you couldn't have something happen sooner, or maybe have some an event like a hip replacement, knee replacement, that you may utilize the long-term care policy for a little bit, get better, shut it off, still have a policy in place. Another great question, how long do you have to wait? There are elimination periods with all these different types of planning pieces. Great question to ask Dane and the group. We have support to guide you through this process. Obviously, working with Dane and his group, you have that support to help you through every step of the way. Our Premier Care policy also includes a care coordination if you were looking at Pacific Life, where you actually have a third party that really helps Dane and your family put plans of care together. So start planning now. So you look at rates. The nice thing about these new modern and newer plans is there are life insurance proceeds available, meaning you're guaranteed to get your money back. So it's good to look at these when you're younger, you're healthier, because that's really the catch with any insurance policy is, am I healthy enough to get this to where the insurance company will give me an offer and underwrite it? And then the inflation, doing things younger and healthier and earlier, you also have that guaranteed inflation that will grow over that time line on a guaranteed basis. So with that, we're right at about 20 minutes. So I really appreciate everybody's time, and Dane, appreciate you having me today. Hopefully we walked away with some ideas, a little better understanding of what's available and some of the solutions out there. I would encourage you to speak with your significant other of what your plan is. Reach back to Dane and the group. Ask them, sit down and look at numbers on your particular plan. It could be self-insuring, or it could be looking at transferring some of this risk as well. So with that, I'll hand it back to you, Dane. And again, I appreciate everyone's time today.
Thank you very much, Clint. I appreciate it. That was a very good presentation. For everybody that's on the call, you may be highly considering long-term care. This may be the first time you've got any kind of exposure to it. Clint did a great job of explaining what your options are, but I think just to kind of reiterate what Clint has said and what we often say with our clients is everybody's situation is going to be different. And so you really got to figure out what it is that fits with your financial plan and your needs and your budget as well. So there's different ways you can do it. There's different ways you can fund the policy. And myself, Mike, Chris, Tyler, we're all happy to sit down with you and explain those options and figure out exactly what's going to work best for you. So that's what I would encourage you to do. Figure out what is the most important to you, write those down, and let's have a discussion. So once again, thank you very much, Clint. Thank you, everybody who came onto the webinar today. It looks like we are going to get done within the 30-minute time range. I would just say this one thing before we close. We will continue to have these monthly webinars. Some of you may have been on some other ones we've had in the past. We will continue to pick a topic and hopefully have a webinar sometime in the middle of the month. And we're gonna bounce around between morning, afternoon, evening. Hopefully we can catch you at a time that works well for you. This presentation and other ones that we've done in the past and hopefully more in the future are going to be recorded, and we'll post it out on our YouTube and website. So if you missed it, if you missed a certain portion, or you think maybe somebody else would benefit from it, go check out our website, check out our YouTube channel, and you may find a recording of this out there available for you. And then speaking of social media, I mentioned it before. If you're not connected with us on social media, Facebook, LinkedIn, go out there and look for How Financial Services. Look for myself on LinkedIn. Mike Howell is on LinkedIn as well. So we tend to post some pretty good articles out there for all of our clients and information for you as well. So we'd love to connect with you there. And like I said before, if you have any questions or anything we can help you out with, don't hesitate to reach out. Phone number is 618-443-2395, or you can email us with your questions as well. So with that, I will sign off from here. Take care.